people are still underinvested in equity. But one of the lessons that I have learned over a period of time is when 1 year returns on funds touch 100%, there is time to actually tell people that it won't be the future. Getting 100% from here is not it's more like a dream in the next 1 year. And that I keep telling people, because as we meet, the last year's bottom base was around the end of August. So, the 1 year return, whenever I've seen people invest on 1 year returns, I've seen that there are times when they get a lot of unhappiness. So I tell people, you're going to it's a very good cyclical, structural phase. But at the same time, to make very big returns, normally you need to invest in pessimism. There is no longer any pessimism in equity markets. There is pessimism in fixed income markets. So there I say the opportunity is great because you're investing in complete pessimism. So when you invest in pessimism, the opportunities are always much better. Whereas today in equities, most people are optimistic. And that's why they're underinvested but optimistic. Which is why it looks like we are in a situation where you can get decent returns in equity, but not the kind that you got in the last 1 year.
What we got in last 12 months was a bumper thing. I mean, that was an extraordinary event. That may not repeat itself. Or do you think things will continue to surprise us on a return perspective because the story is so strong and because we are going through a structural change post the new regime?
If you look at what has changed, like we were in a cyclical low, a low of a lifetime where virtually everything stopped. From there we are coming back. If you look at the base effect advantage of the return is behind us. That's clear. But alternatively, most other asset classes today are not there to allow you for getting even 7-8% compounding, except maybe certain debt instruments which can benefit from the change in the interest rate regime. So directionally, if people have time on their side, there's still compounding possible over a 3-4 year period. The degree of compounding just cannot be what has been in the last year, because these are extreme returns, because if you get it for 3 years, all of us retire on a compounding basis if you get those kind of returns. But I think reasonable, good compounding on a sustainable basis is possible. Yes, you should have 3 years on your side or a meaningful period of time on your side, and you have the whole earning cycle yet to play off, and that will allow for those returns to come.
No one has participated in last 1 year. I would say not 99, but 99% of Indians are feeling left out. All of them are getting this feeling that the train has left the station. So how should one now prepare their portfolios for someone who's not participated in last 1 year for whatever reason, but now is ready to take that dive?
I think we have a long way to go. The ingredients for a sustainable market are very much in place, which I put it, a stable macro with this kind of political mandate. I think the earnings growth for next 5-7 years, there is good amount of visibility that will at least go back to the long range profit growth of 14-15%. Valuations are reasonable. Of course, they are not as cheap as they were exactly a year back, but I think they are reasonable in line with long-term historical range. So I think we are okay. You are not entering market at, let's say, a 25 PE where the return expectations have to be extremely muted. And the last piece, I think, liquidity flow, because I still believe that for foreign investors to look at the asset classes where they are trading in the rest of the world. I mean, Naren talked about Spain and Italian bonds, but you look at every single asset class in the world. So the US 10-year Treasury at 2.4, German bonds at 0.93 for 10 years, Japanese bonds less than 0.5%. You look at every asset class you look at. I mean, people are investing in aluminium to earn, 3-month at the money call options that trades at like 12% volatility, because you just want to put money which can earn 1 or 2%. And in that environment, I think India still offers a lot of hope, both for the fixed income as well as the equity market. And the domestic investors have just started participating. We have a very, very long way to go. I think the portfolios are massively underweight equities. So I think we have this a good concoction in place, and I think somebody was mentioning about can Sensex touch 100,000 in 10 years. That's, I think, if I calculate rightly, roughly 15% per annum. That shouldn't be, I would say, I think it's not an unreasonable expectations. I think over a long period, corporates have been in India may not have happened in several other parts of the world, but in India have been able to deliver profit growth in line with the nominal GDP growth. So maybe I think that's quite likely. Forget about a PE re-rating or de-rating, add little bit of dividend, and I think 15% is possible.
So no, for those who are expecting that Sensex could be 1 lakh in 10 years, are they bearish?
While 15% earnings growth rate doesn't look difficult, the fact of the matter is we've not had 3 years of 15% plus earnings growth rate except in the period of 2003 to 2008. You need to get the right kind of macro factors in place for you to deliver that number on a consistent basis. Of course, we can get 2 years or 3 years, but to get it for the next 6-7 years in a row requires that we have in place macro factors which remain fairly comfortable and positive. And here I'm not just saying that our domestic inflation rate or domestic GDP growth rate have to be in consonance. You also have to have global factors which are as benign. In the 2003-2008 period, one of the biggest beneficiary of a very benign global factor was India and almost all emerging markets. Whether we have the same kind of benign global factors going forward is a big question mark. So, while sitting in India, as was mentioned by Naren, we find, India has got, that almost no other alternative, and we feel we've done so well. But this is part of a global emerging market move that we've seen. Last year there was a similar kind of aversion against emerging markets, and we just swam against the tide for whatever reason. So if we have global factors which remain benign and support our domestic macroeconomic factors, then it's possible. But it's like saying that Indian cricket team goes abroad and can win series after series, which it should based on the kind of averages Indian players have. But unfortunately that has not been the case in the last 10 or 15 years of track record. So we can build it on hope, but the reality will require a lot of factors to come in place.